Hello and welcome to this special presentation of Trading Places Live. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and I'd like to share with you today a few little secrets about the stock market action in 2022. Today's agenda is going to be very, very simple. Just have a couple of charts. I've got an Excel spreadsheet. I just want to go through some things with you that I think you're going to find really interesting about the stock market. I'm going to start off with market rotation and show you how I used that in 2020, well, at the end of 2021 and in 2022 to help call the stock market top at the end of the year and also to call the bottom in mid-June. And then I also want to show you, I guess I'd call it the 4 phases of this cyclical bear market. And I want to show you a few things on an Excel spreadsheet and then also on the charts that I found absolutely amazing. For those of you who don't know me, I was in public accounting for 20 years, was a CPA in one of the largest firms in the Washington, D.C., Baltimore, Maryland metropolitan area. And I love to analyze. That was one of my real strengths. I'd love to go in and analyze companies to see what makes them tick. And I do the same thing with the stock market, always researching, trying to learn from history. And I want to share some of that with you today. So before we get into that, let me just show you, first of all, if you do enjoy this presentation, then I would strongly encourage you to join me on Saturday, August 27th at 10 a.m. This is a free event. Where does the market go from here? This is going to be a little bit of a mini market vision event. Back at the beginning of 2022, and actually for the last 3 years, we've had Market Vision 2020, Market Vision 2021, Market Vision 2022, highlighting the way we thought the year would unfold. And the last 3 years have been pretty remarkable. I'm going to basically do that again Saturday, August 27th, because we've been through so much. And so a lot of the questions right now are, what in the heck is going on? Where are we going to go from here? Well, tune in Saturday, August 27th. If you go over to EarningsBeats.com and simply click on this link, it will take you to a page where you can sign up. You can go through. There's a lot of information, predictions that have been made the last couple of years. You can check those out. Just make sure you sign up with your name and your email address into and click on that Save My Seat. Make sure that you're in. Also, there's another spot up here. We want to make sure you get signed up. But whatever you do, please make sure you come to this event. I think you're going to find some very informative charts, lessons that I think will help you as you try to navigate the balance of 2022 and head into 2023. So just make sure you go in and sign up over at EarningsBeats.com. All right, I'm going to go ahead and get started. I want to start with the market rotation. Now, this is a 1-year chart of the S&P 500. And then I have some ratios down here below that I like to follow, just as a kind of a confirmation, if you will, of what the S&P 500 is doing. Now, going into the end of 2021, the S&P 500 was just rolling along, setting new all-time highs, did it in September, did it again in November, and then finally at the end, in late December, early January, we set new highs again. But things started to change. And when you're listening to the media, particularly CNBC, they don't alert you to these changes. This is on the charts. You know, what CNBC is interested in is making money, and the way they make money is to bring in advertisers, and the way they get advertisers is to show them how many people are clicking and watching CNBC and clicking on all of their articles and their ads and whatever. They want to make sure that they've got a huge representation of folks, because that's what's appealing to an advertiser, and that's how they make their money. So a part of what they do, and I'm going to say a small part of what they do, is to educate. They bring folks in who are supposed to know a lot about the stock market and so forth, bond market, and they interview them and so forth. And some of what is said is educational, but a lot of it is just drama. And so for me personally, I stay away from it. But let me show you the real story. It's not on CNBC. It's on your charts. It's at StockCharts.com. So here's the S&P 500 rolling along, moving to new highs right into the end of 2022. Now, as it's going up in September and then reaching new highs in November, I want you to look at these sustainability ratios. These are ratios that tend to mark or tend to suggest to me anyway, whether or not a move in the S&P 500 is sustainable. Is it going along with what the S&P 500 is telling us? So as the S&P 500 goes up, one thing that we want to see is we want to see consumer discretionary outperform consumer staples, XLY, XLP. Very simple. These are your consumer discretionary stocks. And the whole reasoning behind this is that our GDP is made up of 2/3 consumer spending. That's a lot. That's a big part of our economy. Consumer discretionary stocks, these are the companies that sell us the things that we want. Think about companies like Tesla, companies like Starbucks, many of your retailers, home builders. This is all part of discretionary. These are the things, if we feel really good about things, these are the things we like to go buy because we really want them. Consumer staples, on the other hand, they're selling us the things we need. So think of consumer staples as being the companies that sell us deodorant and soap. And I want you to think about how often you buy these things and in what type of market environments. So if things are really humming along, your retirement's soaring, your home prices are going up, you're feeling wealthier, stock market's good, you're probably not going to worry too much about going and getting that latte at Starbucks. You're not going to think about maybe upgrading from the car you have, getting a new car, or maybe making that move that you want to make. Those are the things that are going to do well when the economy's humming along. Now, if the economy's humming along, do you buy any more soap? Or do you buy any more deodorant? Of course not. You don't do any of those things. So the thing to understand here is that when this ratio is going up, it's generally a sign that there's more growth in those discretionary names. And that's what drives the stock market higher. That's telling you the economy is strong. Now, when Wall Street starts to reposition into defensive staples, like they did in the month of December, then you're going to see this ratio start to go down. And when that occurs with the market going up, it's telling you something. To me, it's telling me that the stock market's repositioning into defensive staples. Now, I have other growth or other sustainable ratios here. I like to follow the NASDAQ versus the S&P 500. Which one is performing better? The NASDAQ's a little bit more growth oriented than the S&P 500. S&P 500 has plenty of growth companies, but they have more value companies. So the growth versus value makeup of the NASDAQ is much higher than it is on the S&P. So again, you want to see that going along with those highs on the S&P 500. And when you don't, like we saw in December, rolled back over, tells you that money's rotating more toward the spider. Well, these other ratios, and as I go through these ratios, they mean lesser and lesser to me. The XLY XLP is my favorite ratio. I really like to see how the NASDAQ versus the S&P is doing. When we're in a secular bull market, the NASDAQ has the tendency to crush the S&P 500. So I like to see that ratio going up to support prices when the market's going up. These other ratios, this is the IWF-IWD, which is large cap growth versus value. And then I've got three other ratios comparing indexes, which also compare large cap growth to large cap value, mid cap growth to mid cap value, and then small cap growth to small cap value. The big point I want to make here is that as we made that final high in 2021, Here was the relationship. This was the performance that month of all of our sectors. Consumer staples up 10%. Consumer discretionary up just 0.15%. So even though the market was going higher, what was Wall Street positioning into? Moving away from discretionary and into staples. That is a big, big warning sign. You can see, though, in the month of December, these four leading sectors, staples, real estate, utilities, and healthcare, those are your four defensive groups. Look at the five aggressive groups: industrials, financials, communication services, technology, and consumer discretionary. Those five groups were getting killed by defensive groups as the market was making a new high. Wall Street was positioning out of those areas, those growth areas. Why would they do that? Because they were looking ahead and not liking what they saw in 2022. How many of them did you hear on CNBC at the end of December telling you to get out? They were getting out. They were repositioning. What were they telling us? In the meantime, all of these ratios turned lower in December. These two, mid-cap and small-cap growth versus value, had already started to turn lower. They were already starting to issue a little warning sign of their own and then kept turning lower. Then I want you to look at what happened during the bear market of 2022. As we went every leg lower down to this low before this bounce, to this low before this bounce, to this low before this bounce, S&P 500 moved lower, lower, lower. I want you to look at the sustainability ratios. Lower, 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 lower. Right across the board. Lower, 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 and lower, lower, lower. Every single one of them. It was saying, hey, we're going along for the ride. This move to the downside is sustainable. But what happened on this final bounce and this final leg down during this period? What happened? The S&P went to a new low, easily to a new low. I pointed out these big gap downs right here. I'm going to talk about those during the second segment of this show. That'll be part of the discussion. But during this last leg, we bounced just like these others, bounced to a new low, bounced to a new low, bounced to a new low. This one was different. Why was it different? As we moved down to new lows, look at the ratio on the XLY, XLP. It actually turned higher. QQQ, SPY turned higher. Every one of these ratios turned higher. They didn't go to new lows. What does that mean? That's rotation. That's Wall Street once again at the bottom, this time moving to more aggressive areas of the market. Go back and run the tape on CNBC and let me know how many of them told you about this. I didn't hear it. Of course, I don't listen to CNBC, so that wouldn't be too shocking. I didn't see too many articles talking about it. Headlines, anyway. Anyway, if you look at this period, this final period, now look at the rotation. Now, I will say staples still did pretty well. Discretionary, though, was right behind. They were pretty much hand in hand. And that's why you can see this ratio right here was relatively flat. But think about this for a second. We're talking about a recession. Recession means contraction. And the GDP is 2/3 consumer spending. Why are these two groups leading? Why would consumer stocks be leading the 11 sectors in a recession, one that's predicted to get worse? Wall Street looked ahead and didn't see that. Again, I think they just failed to mention. They must have forgotten to tell us back in mid-June. I called the bottom in mid-June. I called the top at the end of December. I've got articles and I've got shows to prove it. On those days, go on YouTube. I did a show on June 16th that said, I'm calling the bottom. I wrote my daily market report to members at EarningsBeats on June 16th. Could not have been any clearer. I said, I am calling the bottom right now and right here, and I am fully invested. Said it right there before we made this move. A lot of folks thought I was nuts. And I even said at the time, I don't know if I'm right or not. I'm just seeing all these signs that are telling me that being short or being in cash on June 16th was the wrong answer. Getting invested, being long, fully investing was the right answer based on what all of my risk analysis was telling me. The opposite was true back at the beginning of January, end of December. So here was that subsequent rally that we've seen since then. And look at the ratios. All the ratios are going up with it. So as we're setting new highs, we are seeing some pretty strong ratios. Now, a couple of them have pulled back a little bit. We do have options expiration coming up here this week, and usually the week after options expiration can be a little rough. So I do think in the short term, the market could be set up for a pullback. Doesn't have to, but it could be. But I think there's no doubt in my mind we've bottomed and we're going higher into year end and into 2023. Unless things change, I'll be talking about all those signals on August 27th. So make sure you sign up for that event. Again, for anybody who came in late, go over to EarningsBeats.com and just click on this, read about it, and then make sure you register for the event. All right, that was what I wanted to show you on this chart. So the top formed when money rotated into more defensive areas. As we kept going lower, the ratios went lower, suggesting we were going to continue to go down. That all changed in June. Again, we saw a bunch of rotation. All of the sustainability ratios were not going down with the S&P 500, suggested a bottom, and now we've seen this since. All right, so this is part one of this. Now I'm going to bear with me for a second because I want to show you an Excel spreadsheet. I'm not going to spend much time on this. I just want to show you a little manipulation, well, a lot of manipulation that takes place. And let's see. All right. So what I did, this is the QQQ. So all I did on the QQQ is starting back on November 19th, and I'll show you November 19th was the top on the QQQ or the NASDAQ 100. So I started there at the very top. This was the highest close on the S&P 500 in history, November 19th. What I did, and I'm going to show you what amateur hour means, which is the first hour of the trading day, basically, or first half hour. And I want to break down what happened in the stock market since November 19th, what happened in the NASDAQ 100 and the QQQ. So I started with the close. I then recorded the price action at the open the next day, and at 10 a.m., 11 a.m., 2 p.m., and the close every day since that date. And what I did, November 19th, we topped. So we went down 402 during this period down to 381. And what I did is I broke down, okay, what did we do from the close to the open? That goes here. What did we do from the open to 10 a.m.? The change went here. The change from 10 to 11 went here. Then the change from 11 to 2, and then the change from 2 to close. It's just breaking down how the QQQ traded intraday each day, and then I summarized it by uptrend versus downtrend. So here's the start of the downtrend. Then we rallied back to 397, again, breaking all this down. Then we pulled back to 379 back on December 20th. And then when the S&P 500 topped on January 3rd, the QQQ got back up to 441.41, but didn't quite get back up to that 402.20. So we didn't quite get a new high, but that's where we were January 3rd. So that was that final rally. And then welcome to the cyclical bear market. Cyclical bear market began. First leg down. This was the big leg down. 400 down to 340, lost $60 on the QQQ. Here was the intraday breakdown. Notice I'm totaling each one of these little segments of time. I'm totaling it by the breakdown of what happened at the open, what happened in the first half hour, what happened in the next hour till 11 o'clock Eastern, then what happened from 11 to 2, and then what happened from 2 to close. All right, so I did that for every up and down. There's the next reaction high, February 2nd. Then the QQQ went to the next low back on February 14th. There's the summary. Did this over and over and over again. I followed this all the way through to the end of the year. Or excuse me, the end of the, right up until yesterday's close, Monday, August 15th. And through this period, from that 402 high down to 333, the QQQ has dropped $69.14 through this whole period. When I added up those those segments, each one of those periods, I added that. I want to make sure my math is correct. I had totaled all those up, 69.14, it agrees. Then I broke down, I did a summary of all the different periods. Just want you to see 69.14. This was a little, just the only thing different here was how I broke down it into 4 columns instead of 5. But again, 69.14 is the total. And then I broke down 4 major phases of this bear market that I'm going to go over with you. And again, 69.14, okay? So I just want to make sure you see that all of these total 69.14. So I know I'm dealing with the same thing. It's just my auditor in me being the CPA. I want to make sure that all the numbers are correct. So I just do that for just audit purposes. Here was the opening gap during every period. This is the net of all the gaps within this period, November 22nd to 12/3, 351. Again, if we go all the way to the top, there's that 351 right there. The next one is 420. So if we go down to this bottom, to the bottom, there's 420. So all I did is I'm just putting these into this nice little table. If the net amount during the period was up, it's in green. If it went down, then it's in red. Hopefully I got all those right. I tried to make sure I got them all right. Now, what I want you to focus on as you go through this, first of all, it's easy to focus on the bottom. This was a shocker to me, by the way, an absolute shocker. The totals of all these periods, first of all, the opening gap, we lost $41.81 due to gaps. I call that manipulation. We lost another $44 in the first half hour of trading. We lost another $27 from 10 to 11. So we lost $85, $86 plus 27. That's $113 that we lost between the close of one day and 11 o'clock in the morning the next day. $113 we went down. But wait a minute, we only went down $69. After you got past 11 o'clock, once you get past amateur hour, market actually did pretty well. We went down a little bit from 11 to 2 on a net basis, and you can see certain periods were worse than others. Look at the net. This was the one stat that really blew my socks off. From 2 o'clock to the close, throughout the entire period, with maybe this one exception, this was January 4th to the 27th, which I think was by far the most, we saw the most distribution. And so we even had selling in the last 2 hours. But if you throw that out, that minus $28 for that period, the 2 p.m. to close went up not 49, but you'd have to add another 28 to it. It went up $77 in every one of these periods if we exclude January 24th to 27th. Think about that. We've been through the 6th worst cyclical bear market since 1950. And from 2 o'clock to the close, the QQQ has gone up $49.45. Pretty amazing. Now, I just want to break down one more thing for you, and that's this summary. The initial rotation, these are the 4 phases: initial rotation, distribution, manipulation, and recovery. Initial rotation, notice the gaps went higher. Yes, the QQQ did not go up during this period. The gaps went higher. The first half hour went higher. We started seeing distribution between 10 and 11. The balance of the day was okay. This is where Wall Street started moving a lot of their money. Don't ask me why it was 10 to 11, but that's where we saw a lot of rotation. During the distribution phase, every time frame went down. Gaps, you were opening lower and you were selling off basically all day long. The manipulation phase was the last leg lower. Look at the opening gaps, $24 down on the opening gap, $8 down the first half hour, another $4 and $4.50 over the next half or next hour. We gained $24 from 2 to 4 o'clock, or excuse me, from 11 a.m. to 4 o'clock. We gained $24 on the QQQ while the market went to its final low. And then the recovery phase where look at all the buying that we're seeing from 10 a.m. to 4 o'clock. Look at the amateur hour. Folks are still thinking we're going to go lower, so they're selling everything in the morning. And then the totals. Now, having looked at that, I'll just show you real quick. Last thing I want to show you is how does this look on a chart? And this is how it looks on a chart. Here's where we're going up. There's that initial Wall Street rotation. There's was the numbers I was showing you. Gaps, amateur hour, 10 a.m. to 11 a.m. balance of the day. So the QQQ basically sideways. And then look at this. Then we go into the massive distribution going down. That's where the gaps down 29, amateur hour down 35, 10 to 11 a.m. down $32, and the balance of the day down 14. Clear distribution. Then the manipulation phase where we gap down 20. That's where I talked about these big gaps. We were gapping down, but we also in this period had a lot of big hollow candles where there's buying intraday. So most of the losses were the gaps. Then you had amateur hour going down, 10 a.m. to 11 a.m. down, and then the balance of the day from 11 a.m. to 4 p.m., we were seeing accumulation. Then the recovery phase right back up with basically all the areas doing well. Amateur hour still struggling because everybody thinks we're in a bear market. So that early morning weakness still coming through. Wall Street's buying. Hand over fist. Anyway, I hope you've enjoyed this presentation. Again, if you like this kind of thinking, this way of thinking about looking at the market, join me on Saturday, August 27th. Click on this, go to EarningsBeats.com, click on this link, and make sure you register now with your name and email address. Everybody have a great day. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.